Okay, I'm back. This is part 3. And you know what? At the end of part 2, I was going over the Fibs. And I'm going to go ahead and, we'll go back to Fibs later on. I want to start out with the moving averages. This is really where it's key. It's very, very important that you learn how to use these moving averages. Like I said earlier, the 144 and the 200, they work together. Okay, moving averages, they usually cross each other, but the 144 and the 200, I'm sorry, the 233, they're not going to really cross much because those are long-term moving averages, and you might get a cross here and there. Like right here, actually was the crossover. It's not going to happen that often. The 144 broke the 233, and that just means the trend is moving up. But what I really look at mostly is the zone in between the 144 and the 233. See this area here. I like to really keep an eye on that. A lot of traders they use a 200 instead of a 233. They use the 200, and I bumped it up to the 233 because 233 is a Fibonacci number, 200 isn't, and 144, that's a Fibonacci number. So, and I really felt that some traders just have the 200 to measure the overall trend, but 233 could be too long of a moving average. So what I do is I use a 144 and I look for a middle ground, and anywhere inside the zone between the 144 and the 233 is an area where you would expect some type of a reaction. In this particular example right here, this area right here, there was a reaction. Price came up, it hit the 233, and then it fell right back down. Came back up again, busted it, came back down, precisely touched it, and then kept going up. Alright, and now here we got the 21 and the 55. The purpose of the 2155 is it's market. It tells you really where the market is going. Not necessarily where price is going, but where the market's going. Because the market could be going up, okay, but price, momentum could actually be falling. I don't take credit for this system. I actually learned this in FX Bootcamp. What's really important about the 2155, they're very powerful areas of support and resistance, dynamic support and resistance. Dynamic meaning that as price goes up or down, the moving averages go up and down. So they move along with price. But moving averages are really important because we want to look at the crosses. We want to see moving average crossovers. When a lower moving average, such as a 21, crosses above the 55, it means that there's a change. There's a change in trend. I love moving averages. I really do. I can't trade without them because moving averages, they're respected. If you look here, price is it's riding the 21. In one of my posts on this thread, I compared it to a roller coaster. When you get on the coaster and it comes up to its first big slope, and then it stops, it pauses, and you hear the chain moving. You hear the I don't know how, I can't do it, but you hear the chain moving, but nothing's happening yet. It's moving, and then all of a sudden it catches on to the coaster, and then the coaster starts to ride all the way up the big slope. Well, I think of that, I compare that to trading, because look, price is caught by the 21, and look, it's riding it like a track, like a roller coaster track. and then here's your slope. This is not a big slope, it falls, and then it goes back up. Now look, it's back under the control of the 21. Zoom it in a little bit. You see? And then look what happens. The 5 takes over. The 5 takes over. Look, some of this is going to take experience. It takes time in front of the charts. But the idea of getting into a successful trade is riding the moving averages. You want to ride the moving average. We're riding the 21 here. Generally, if the 21 breaks, if price breaks the 21, the 55 usually takes control. Here's a situation where, by the way, this is not exactly an area where I would trade, because everything is braiding. And that's another important thing about moving averages. They tell you when not to trade. When you see price, when you see moving averages braiding like this, it means that really price isn't doing anything. You don't want to be in the trade. But when you see the cross, like here, this is when you want to get into the trade. Price, the moving average, the 5 moving average crosses all the other moving averages. Price wants to ride the 5. I love to ride the 5. And here it comes down, does a dip, overlaps with the 21, the 233, and the 38.2% fib. Gosh, that is a great opportunity to get into that trade. That's confluence. It's overlap of 2 or 3 different areas of support, and that's on the hourly chart. Who knows what's going to be on the 15 and on the 4 hour. Now, move this fib over here and swing low to swing high. By the way, these are fib extensions, and we're going to save that for another lesson. These are areas where we would consider to get out of the trade. We use Fibonacci extensions for profit targets. But anyway, here we go. Okay, I'm back. Quick bathroom break there. Here's another fib. Price comes down, hits almost hits the 50%, overlapped with the 21. And the 21 wants to carry price up. It really does, and it is doing it. We're still gliding over here on the 38.2, but look what happens. The chain on the roller coaster track catches up to the car and just lifts it up. Right here, see the 5. Now we're riding the 5. Price falls, breaks the 5 EMA, touches the 21. 21's in control now, and it's carrying price up. Price hits this area of resistance, this trend line. It's forced downward. This is a great buying opportunity. And it's a fib, and price comes down, hits the 38.2 fib, and it comes back up. So what I'm doing, pay attention. Okay, here we go again. A 50% fib, 21 EMA. We're actually in between the 21 and the 55, and once again price continues to go, to move. So as you can see here, we could use fibs, moving averages, and trend lines to as confluence areas where they overlap. Let's go ahead and this is fractal geometry. Trading is all about, it's all fractal geometry. Every piece is just a smaller piece of the entire picture. So the 50-minute is just a building block of the 1 hour, and the 1 hour is a building block of the the 4 hour. Let me turn this into a weekly chart for a second. You see, here we are, in this area, we're obviously in, this is a weekly chart. So each one of these candles stands for a week. So we're inarguably in a weekly uptrend. But there are red candles along the way. That means that for this entire week, price was falling. So we may very well have been in an uptrend, but here, this would have been a sustainable downtrend that could have lasted well, several days. So everything is a piece of the bigger picture. So if we actually turn this into a 1 hour chart or even a 4 hour chart, this would look like a downtrend. In fact, this can, well, you know what? This candle goes back to March 20th of 2011. So turn this into a 4 hour chart. Let's go to March 20th of 2011. Okay. See? Now on the 4 hour chart, that was this downtrend is that candle that I just showed you on the weekly. Look at this. This is a very long downtrend. This is a 4 hour chart. I mean, this is like a half a week. Price just fell. And then it, eventually went back up. So everything's fractal in nature. So here's another perfect example. By the way, it's very important to get familiar with candles. This is a hammer. It's like a doji. And what happened was price came down and it hit this area, which obviously, well, it actually precisely touched this trend line, which we created earlier, and it was respected. And price just took off. If you look at a long wick, it means that there was a lot of buyers here. And when the other traders saw that there were a lot of buyers here, they got out of the sell, and they probably entered the buy. And here's another example of price riding the 5. I would take a fib from here to here. And look at what you got. We basically practically touched the 38.2 fib right here, and this is where the 5 EMA is. You want to get on that 5, and if you enter the trade here, you would have got on the 5, and you would have set your stop loss somewhere down here, just underneath these moving averages. Just under the moving averages and the 61.8 fib, and you wouldn't have been stopped out. Price would have just kept going and going and going. Here it doesn't quite reach a fib, but we're looking at a 15-minute chart. Now, if in real time we were looking at this and at a 5-minute and a 1-minute, we probably would have saw plenty of opportunities to get into this trade. For example, here's the top of this candle. Look at that really carefully. Actually, this would have been a double bottom. See? That's a 78.6. So you probably, the only thing that would have got you on into this trade would have been just one thing and one thing only if you're looking at this chart, the touch of the 5 EMA. But keep that in mind. That's a great way to get into good trades. Wait for price to come on down, touch the 5, enter the trade, and put a stop loss maybe underneath the 13. That's it. Price just took off. This is it's a 15-minute chart, and this is Friday's non-farm payroll.